Hello everyone, my name is Chris Cairns. I'm a partner at Alliotts Chartered Accountants. We're based in London and the southeast of England, and I want to talk to you today about things that you should be considering if you're thinking about setting up in the UK, perhaps why you might want to set up, where you might want to set up, how you might want to structure it, and things to look out for. Now I'm going to start off by talking about why I think, or why I hope you will agree with me, that the UK is an attractive location for you to set up a business. Firstly, the workforce, particularly in the southeast of England, but across England as well, but particularly in the southeast of England, is a highly skilled, service-driven workforce with most businesses really in the service industry. There's not as much manufacturing and hard industry effectively in this area. Also, from both a personal and corporate standpoint, the UK has a pretty attractive tax regime, and I'll talk a bit more about that throughout this webinar. One thing which would have been covered in the press quite a lot, but will be important, is that the corporation tax rate, so effectively the rate of taxation that companies or your company would pay in the UK on profits in the UK, is actually dropping, and it's going to a flat rate of 20% by 2015, which is a pretty good tax rate, I think, across the global economy. Added to that, if you're making profit, well, hopefully you will be making profits in the UK, in your UK company, when you're set up and running, and you want to pay dividends from that company across to your holding or your head company in your own country, there's no withholding tax necessarily to be deducted. So basically, when you pay the dividend across, you don't have to hold any tax back on those payments. You can actually transfer the lot across to you. Combine that with the legal system and the business infrastructure, which is well established, well proven across the global marketplace. So if you have intellectual property, etc., it's going to be well protected in the UK, which isn't necessarily the case in certain other global locations. The government, both this government and previous governments, and we fully expect future governments, have stated that it is one of their main focuses to incentivize creative and innovative businesses. Now, innovative businesses don't necessarily have to be technology businesses. It's all sort of businesses. Admittedly, I'm going to be talking about some of the tax benefits of technology side businesses, but this is across the whole board. They really are trying to push, London, the southeast of England, is a real, a great place to be working and setting up. Now, as a company, if you set up a company, one of the best tax benefits of all, I suppose, is if you set up a company that's undertaking research and development of any type. If you're a SME, so a small business, effectively, and that small business can be up to 7, 8, 10 million pounds. Don't think of small as just small. For every £100 you spend on research and development, you can actually get a tax credit of £225. Now, quite often, when I speak to clients who are undertaking research and development, they won't necessarily be making any profits that would be chargeable for tax. So they're saying, well, why would I care about a tax credit? Because I'm not going to be paying corporation tax, because I'm actually making a loss because I'm undertaking so much research and development. Well, the thing that's great about this research and development tax credit is that you can, even if you're making a loss, you're not making profits, you're not paying corporation tax, you can surrender that tax credit and actually get a repayment, so a cash repayment from the UK government against the research and development, which is brilliant. And I have a number of clients where they don't, unfortunately, they're not making profits because they are undertaking so much research and development, and the UK government is effectively paying them or incentivizing them around that via this R&D tax credit system. Now, even for large companies, there's still an R&D tax credit which can be claimed. Although that's at 130%, so you get basically a 30% uplift, which is still, I think, pretty good stuff across the board. And I suppose that probably explains why, in terms of all of the technology businesses across Europe, 23% of them are already in the UK, with the vast majority in the southeast or London. Now, I suppose to follow that on, well, why would people think about the southeast of England. Now, what do I mean by the southeast of England? Well, on the map on the screen there is what I consider the southeast. So we've got Greater London, which is the grey blob, and then the southeast is all the counties around that. Now, the world's press have actually called the southeast the UK Silicon Valley, and you'll see that I think like the mayor of New York has been quoted as saying that London's a real competitor for technology businesses. It's home to one of the largest clusters of research-intensive corporate headquarters in the whole of the UK. You might be interested to know that there was a study released recently, actually, I think it was at the end of April 2014, which showed that in terms of technology-based employment clusters, Wokingham, which is actually in Surrey, outside of London, was number one. London was in fact number two. I think part of the drive for so many technology businesses, and particularly the southeast, as well as the government's focus and research and development credits, etc., part of the reason for there being so many is that we have 20 universities in the southeast of England, our higher education universities, which are producing nearly 70,000 skilled graduates each year. So this gives ready access to businesses for the best and the brightest minds in the UK who are at the cutting edge of technology and research. I suppose the result is pretty unsurprising that 9 of the top 10 fastest growing software companies are in the southeast of England. Right, so I've talked about why I think, what I think the UK has to offer, why so many people are setting up in the UK, why you might want to consider setting up in the UK. But what I want to talk about now is how can you actually do that? What are the nuts and bolts behind how you can do it? Well, basically there are two ways you can expand into the UK. One is you could set up a new entity, and by setting up a new entity, really your choices are either a branch or a limited company. And I'm going to talk about some of the pros and cons behind those in a minute. And the second way of doing it is to buy an existing business, so one that's already set up. And in that case, I'd strongly advise, in fact, I'd insist really that anyone who's thinking about buying an existing business, you need to undertake a due diligence report on that target company. And again, I'm going to talk about that in a minute. So first off, branch or subsidiary. Now, what is a branch? And I think it can be quite confusing sometimes. A branch is not a separate legal entity. It actually is part of your company. So if you think about it as effectively an office you've set up in the UK, which is part of your company in whatever country you are based in, it'd be taxed as part of your company, it will appear as part of your company's results. Some of the benefit of that is that any startup costs, so the costs in actually setting it up, getting it running, getting the trade up to speed, can be relieved against your company's profits. You will, however, probably have to file your company's accounts publicly as a result, which might not be a way or a process that you want to go through. And also, if it's a real success and it starts growing quickly, and you think, well, actually, now could be the time for me to incorporate it, so to actually transfer it or change it into a subsidiary, a separate legal entity, then you can do that. But if you do it when the branch has been set up for a while and it's really flying, you can actually trigger tax liabilities by incorporating it at that point. So that could be a significant downside. Now, the alternative to a branch is a subsidiary. Subsidiary is harder to set up because you are setting up a separate legal entity. You're not just opening a branch. However, as it's a separate legal entity, any liabilities that occur within it are ring-fenced to within that. So the potential exposure to your holding company or your group companies over in your country, it is limited, which for some people, if you're moving into a market or an economy where it's your first steps into it or an expansion into it, for some people that's a real benefit. By having it as a separate legal entity, there's a benefit that when you repatriate, so when you actually move any profits it makes back to yourself, you can choose how you do that. So it can be quite flexible. You can plan it. You can consider what's best for you in terms of timing, in terms of funds flow, and in terms of how it would be taxed. As I said, I think it was the second slide or the first slide, there's no withholding tax on dividends. So if dividends are paid across, you don't have to retain any tax back on that. And finally, and it's not necessarily always the case at all, I don't don't want to say it is, but there'll be some UK customers who will just feel more comfortable dealing with a UK company where they can see, they can feel, they can touch, they have a legal agreement, you know, for trade, for distribution, whatever, with a UK company, than dealing with a branch of an overseas company where the relationship's a bit more distant, where, you know, the laws might be different, etc. Now, the second way of expanding into the UK that we talked about was to actually buy a company. And I mentioned that I would insist for anyone doing that they do a due diligence. And the way I liken this is, if you were buying a car, you would have a good look at it. If you're spending more money in buying a house, you're going to employ a solicitor to do a survey, etc. on it. Normally, if you're buying a company that's a company that's already up and running, it's going to be a lot more expensive than a car or a house. And it's vitally important that you have a firm of professionals give it a really good look over, so you can be sure that what you're buying is what you think you're buying. Now, the benefit of buying a company that's already set up is clearly it's set up already. It's running. It's already got a business. It's already got a trade. You're going to hit the ground running. You already have market exposure, and it's a way of actually coming into the country and just being off and running. The thing about a due diligence, and as I said, it's to make sure you're buying what you think you're actually buying, is it's going to actually produce a report which will look at, for instance, the forecasts that the people who are selling the company have produced. And you know, if you're selling a company, you're going to show things in a fairly rosy way, but there might be some sensitivities in there. There might be some assumptions within that whereby it might not be quite as rosy. There are potentials it could be not as rosy. Now, you need to know that before you buy the company. You need to know that as part of your negotiations over the price that you're going to be paying for it, and you need to know that so that you can structure your plan going forwards accordingly. Now, a financial due diligence report is normally undertaken by a firm of accountants. So, for instance, I can do that if you wanted me to, but any firm of accountants could do that. And it's designed to give an independent review of the robustness of your target. It's designed, as I said on the screen here, flag any risks you're not aware of, and to give you a level of confidence around its performance historically and also the projections. Quite often it's an important document in helping to negotiate on the price, and really you want to make sure there are no skeletons in the closet that you don't know about. Alongside of financial due diligence, I normally would advise clients to undertake some form of people due diligence, because in many of the acquisitions that I've seen, if they are to subsequently fail, quite often they fail not necessarily for a business reason, which isn't known because they've had a due diligence report, but they fail for some sort of cultural mismatch reason. And I would say to my clients normally, you need to be looking at that as well and alongside it, because I think quite often it's almost equally as important. Now, talk through how you can come to the UK. Even before you do come to the UK, there's a very important step that you need to think about first. And it's probably not going to the moon, but I think it's a pretty good picture. I'm not sure what part of the Earth are over there, but when you're coming in, you need to make sure you have the right professional support. That professional support needs to be able to work with you to identify, you know, what you're looking to achieve, what your key strategies are, what time frame you're going to be doing it over, what the exit strategy is. Are you looking to sell in 5 years? Are you looking to expand into Europe, the rest of Europe rather? Are you looking to go to America? Are you looking to expand into Australasia or China, etc.? And you need a firm of professional advisors to support you on that, to help work with you on that, to achieve your goals, so that they can ensure that how you set up in the UK is structured and in the correct way and is tax efficient. And I've talked through a number of points there which you need to be looking out for, and it's vital really that when you come to the UK you're set up from the start in the right way, because it's much harder to put it right later than it is to get it right in the first place. Also, you need looked after in terms of compliance and statutory requirements, and operational efficiency, employment matters, and growth and strategic advice. Now clearly, you know, as a bit of a plug, Alliotts and us I could do all of that for you, but what I would try and impress on you is, if you come to the UK, make sure you have that support in place before you actually go too far down the line. Now, I hope you found that useful. I've deliberately tried to avoid making anything too technical. I wanted to give you an overview of the things I think you're important to be thinking about. If you're thinking about setting up or acquiring in the UK, as I say on the screen, please do give me a call. It's free, there's no obligation, and I hope I could steer you in the right direction and set you on the right course. Thank you very much.